Assalamualaikum everyone. So today our group will represent to all of you about the article AB Jackson and ESLO 2023 about accounting for digital asset. Today I will be explaining the definition of characteristic of financial instrument, including financial asset, financial liability, and equity instrument, especially in the context of digital asset like tokens. So what is a financial instrument? A financial instrument is essentially a contract. It creates a financial asset for one party and a financial liability or an equity instrument for the other. This instrument form the backbone of financial reporting and help us understand a company's financial position. So let's start with the financial asset. This includes cash, share or equity of another entity, a creditor right to receive cash or another financial assets, or a right to exchange financial instrument under favorable condition. For example, security tokens, which are digital representation of ownership, can be classified as financial asset because they may give the holder rights to dividends, voting, or even residual interest in a company. That makes them similar to traditional financial investment. So we go to the next, financial liability. Financial liabilities represent obligation to deliver cash or another financial asset. In the digital asset world, when a company issue a crypto token that must be redeemed or settled later, it creates what is called a crypto liability. It is treated just like another debt on the company books. So for the last one is equity instrument. Equity instrument represent ownership. They give holders a claim on what is left after all liabilities are paid. Basically, a share in the company's success. In the digital world, some tokens might offer voting rights or a claim on profit. If they meet this condition, they could be classified as equity instrument. So for the recap, financial asset give rights to receive value, financial liability are obligation to give value, and the equity instrument is represent the ownership.
Next, I will be presenting the current four accounting practices for digital assets. Number one is intangible assets, IAS 38 or ASC 3050. Digital assets like Bitcoin are often classified as an intangible asset with an indefinite useful life. They are recorded at cost and only adjusted for impairment losses. Revaluation is not allowed unless using the revaluation model under IFRS. However, this method may not reflect true market value, potentially understating the asset worth. For example, Tesla reports Bitcoin as an intangible asset. Number 2, inventory, IAS 2. When digital assets are bought and sold as part of regular business activities, they can be classified as inventory. In this case, they may be measured at fair value less cost to sell using the broker trader exemption. Still, some argue that cryptocurrency don't fully fit the inventory model, as they may not behave like typical commodities. Last but not least, financial instruments, IAS 32 or IFRS 9 or ASC 8025. Some companies classify certain digital assets such as security tokens or stablecoins as financial instruments if they carry contractual right like dividends. However, the IFRS interpretation commit states that most cryptocurrency do not meet the definition of financial instrument due to the absence of contractual obligation. Still, when the substance of the asset is financial in nature, this classification may apply.
Other than that, there are some problems arise related to the topic highlighted in the article. Firstly, there is lack of specific standards. Companies are forced to interpret and adapt existing standards, such as intangible assets, inventories, or financial instruments to fit these new and evolving asset types. Most firms classify digital asset as intangible asset IAS 38, which is not for highly liquid tradable digital currencies. It can lead to complexity in accounting. Other than that, there is also comparability issues. which is different firms apply a different classification for similar assets, which are cryptocurrencies should be accounted under IAS 3A intangible asset and accounted in under IAS 2 inventories if they are held for sale in ordinary course of business. It would make the measurement rules different, which are intangible asset is measured at cost or revaluation model, meanwhile the inventory would measure at the lower of cost and net realizable value. It will result in inconsistent financial reporting. Furthermore, there is also misalignment with asset nature. Digital assets are currently classified and reported in financial statements does not reflect their real-world economic characteristic, purpose or use. There is an argument of the classification of cryptocurrencies, whether could be as a cash. Cryptocurrencies are often used like cash, but under IFRS IAS 3A and US GAAP ASC 350, they are typically treated as intangible asset, while in accordance with IAS 21, the reflect of changes in foreign exchange rate, transaction would need to be translated from the cryptocurrency to the functional currency. It can be made difficult given the volatility observed in this market. Other than that, impairment rules understate value. Under IAS 2, digital asset needs to be recorded at cost and subsequently measured at the lower of cost and net realizable value, which any realized movements in fair value are not recognized, while below cost would be recognized in income statement. An increase in fair value and not recognized in income may lead to not useful information in financial statements.
Next, I would like to share some important recommendations aimed at improving accounting standards for digital assets, a rapidly evolving area in the financial world. As digital assets like cryptocurrencies become increasingly mainstream, it's becoming clear that our current accounting frameworks are struggling to keep up. These assets often fall outside the scope of traditional financial reporting standards, leading to inconsistencies in how they are accounted for and disclosed across organizations. This results in confusion for stakeholders and a lack of comparability in financial statements. To address these challenges, we propose two key actions. First, there is a pressing need to develop a new standalone accounting standard specifically dedicated to digital assets. Such a standard would recognize and accommodate the unique characteristic of these assets, such as their high price volatility, absence of physical substance, and the decentralized nature of blockchain technology. A tailored standard would provide more clarity, consistency, and comparability in the way digital assets are measured and reported, benefiting investors, regulators, and companies alike. Second, we recommend that existing accounting standards be revised and updated to better address the classification and disclosure of crypto assets. This includes explicitly recognizing digital assets within the scope of financial instruments and enhancing the disclosure requirements under current frameworks like IAS 38 for intangible assets and IAS 2 for inventories. By doing this, we can improve transparency, ensure that the economic realities of digital assets are better represented, and help users of financial statements make more informed decisions. In short, updating and expanding our accounting standards is no longer optional, it's essential. As the digital economy continues to grow and evolve, financial reporting must evolve with it to remain relevant, reliable, and useful in today's environment.
In the conclusion, we would like to comment about the issue highlighted by the article. First, digital asset needs special rules. There are many kinds of digital asset now, like Bitcoin, NFT, and stablecoin. Right now, accounting rules don't clearly explain how to report them. In my opinion, using old rules that were made for digital asset leads to confusion. Second, different companies report them differently. Some companies treat digital asset as an intangible asset, while other companies will report them as inventory or financial tool. This would make it hard to compare between companies. I believe this inconsistency can mislead investors and users of financial statement. Third, we need a new company standard. I agree with the author, which that is better to create a brand new rules just for digital asset. This will make reporting clearer and more consistent for everyone. Next is action should be taken soon. Since digital assets are growing fast, I think it's important for rules makers to act quickly. If they wait too long, the gap between technology and proper reporting will get bigger. Last but not least, in my view, if we want financial report to be clear, fair and useful, we must update the rules to match the digital world and we live into it.